What's going on, everybody? I'm going to be starting here soon. Give me one moment. All right, everybody, welcome in. Sorry, give me a second here. Still fix some stuff. Gotta fix my green screen. Me green screen. How's everyone doing today? Okay. We're gonna go over today some very important levels. It is obviously a new month of trade. We have some gigantic expected moves. For those that don't know, I'll explain what expected moves actually are. So we're going to go over all that stuff. We'll see if ICT himself, Michael, will show up on the live stream. He challenged me on Twitter. Now, somebody pointed out that he does this frequently and never shows up on live streams. So I have high hopes that this guy will show up. And, you know, if you're one of the ICT people that follow him, then please tell him, comment to him, say, show up. He's live. Tell him that show up, you know, come in here and let's see if he actually shows. He's the one who brought it up. So I'm just kind of following through, but we're going to go over some key levels. More importantly, expected moves from a weekly perspective. We'll go over the daily expected moves to monthly, because it's November, a new month. Okay. And then we're going to go over just what's happening right now on the tape and some key 0-date levels. We'll look at market net flow and all that good stuff. Give me a second, because I want to make sure that he actually, that if he responds, right? And he hasn't so far. I gave him my email. I saw that he responded to Patrick Wieland, just like a few minutes ago. So he's active on X. He sees what we're posting. But apparently he's just he might be just dodging, and that's okay, because we're gonna still go over some important stuff. And then if you want to talk about individual stocks, you think he's gonna duck? I don't know. I'm holding up to. I'm having hopes that he shows. I really am. You don't think he'll show up for sure? I don't know. I mean, he's the one that brought it up, so we'll see. If he doesn't, then it is what it is. I'm gonna lower this volume, and we'll take a look at markets. By the way, if you don't follow Matthew Ryan on Twitter or on X, I would suggest. Sorry, my audio is clipping a little bit here, I think. If you don't follow him on X, I would go follow him, because he understands this market structure stuff too, and he posts some very quality content. He's there on the YouTube chat. Let me just check sure here. Okay. And then just drop a comment if you see him. If you see by any chance he messages me on Twitter and I don't see it right out of the gate, just post it in the chat, because I have, you know, only so many screens that I can kind of have up here. But I'll do my best to kind of follow up and check. Okay, so we're seeing a little bit of a market sell-off today. We're coming into and around a very important level. What is that level? It's 5,700 on the SPX. Okay, so if I go to gamma and I look at 0-date gamma exposure, take a look here. See this big level right here? Why is my thing not working? Give me a second. There it is. There is a lot of exposure for the day at 5,700. So in my opinion, if there's not going to be much traders reaching past 5,700, we're looking at downside cap pin in and around 5,700 today. Okay. That is what the market is currently reading out to be. That's where concentration is at, is 5,700 by a large margin. Okay. And it's been growing throughout the day. Now, before the day started, what did we talk about? We talked about 5,700. Now this is the CFD. This is SPX 500 USD on TradingView. So if you look at CBOE, it's going to be a little bit different, right? So if I pull up, oh my gosh, I reset my computer. So now I got to reload Thinkorswim. Give me a moment. I'll load up Thinkorswim. But if you look at, once this hits 5,700 here on my chart, it'll probably be a little bit different than if you're looking at SPX from CBOE. And the reason here is because I like to look at this from a continuity perspective. It's easier, but if you want more accuracy, CBOE is probably the way to go. But this tends to work very well for gamma exposure levels. So as the price is coming down here into 5,700, let's take a look at what market net flow is telling us. Actual market net flow. Now, first and foremost, the sell-off occurred when what? When we started to lose convergence here. You started to see the cumulative net premiums of calls start to head down. You started to see the cumulative net premiums of puts start to increase, okay? And then once you lose convergence, which is just basically telling us that SPY no longer is moving with the direction of market net flow, you can have counter trend moves to that divergence. And since this little gray tick, right, since we turned over, what has the market been doing? That white line, SPY, it's been going down. So now where do we go to? I would say 5,700 is kind of around this floor as it stands, looking at the 0-day levels. So undercuts, trade around, and then we can get into more finite market structure to determine whether or not we're going to see a legitimate bounce from these levels. So give me a second. I want to log in here onto my Thinkorswim platform. Hey, hey, Matt Ryan, if you're still in here, man, can you post your Twitter handle? I'm streaming on 3 platforms, by the way. I'm on Twitch, I'm on YouTube, and I'm on Twitter. So, by the way, if you're on Twitter and you're watching, I don't really see live comments there. So, if you want to, I don't know how to pull up live comments on Twitter. So, if you are interested, come over to YouTube or go to Twitch, and I could read your comments. I'd have to, for some reason, the live platform for Twitter is very odd to me. But I'll go in and I'll check every once in a while, okay? Okay. Now, as we all know, we have election stuff going on. We have earnings still going on, okay? And then we have, on top of all of that, we had the Fed interest rate decision going on. And there's a 98% probability that we're going to be, basically 100% probability the market is pricing in we're going to be moving 25 basis points, another cut, okay? This meeting is November 7th. Now, I want to go to SPX, and I want to just show you the insane amount of volatility that the market is currently pricing in. Okay, so did you see this? We're kind of coming into and around that 5,700. We're actually floating around there right now, okay? But on my chart, on the continuity chart, it didn't show there, so there's a little bit of a differential there. Okay. Okay. So back to the trade tab, and I want to show you kind of what this week looks like for expected moves. Now the week ends, right, in 4 trading days now. So November 8th. And what you'll notice here is these expected moves. They're going to be small, but I'll read them off. You have 24, 50, 100, 134, and 147. So progressively through this week, the implied move is rather large. Now, the week started very, very large, okay? So, I want to show you just how much the market is pricing in as far as risk this week. Now, I have data going back a long time. I started drawing it on this chart because we went 4 weeks without touching the weekly expected move. Now, this year, and last year. Now, let's first start off saying, what is the implied move? What is the expected move? The expected move is not just levels that you draw on a chart, okay? These aren't just randomized levels. This is looking at the options chain at a very specific expiration and a calculation based off of all that data leading up to that point. And it spits out what the market says as far as projected risk. Volatility, there's two types of volatility. You have HV and IV. IV is implied volatility. That is what we're looking here. It's a forward-looking indicator, in my opinion, right? It's a forward-looking indication of what the market is pricing is for risk. Historic volatility is something like ATR, right? The average true range. And there are various indicators that you can use for historic volatility, right? Predicted ranges. I have, like if I go to something like, if I go to here and I go into my studies, I even coded this. I call it predicted range. I don't know what the real name of it is. It's a calculation based off of another individual. What was his name? I forget his name. I put it in the script. Buddy Carter. It's a calculation. Here's the calculation right here. Okay. So I apply it and now it shows you, right? Historic volatility. This is a calculation. So it forward looks at risk. So look at right here. Here's the SPX. Now see this line here, this green line, this red line? This was predicted based off of the prior day, and so forth. It's taking historic volatility and pushing it forward. And look at, when I show you these up and down little areas, do you see how price is kind of managing to stay somewhat within those predicted ranges? That's a benefit of historic volatility and looking at that. And you can see we even came into this level today and we kind of bounced from these levels. The daily expected moves, like for example, the ones that are on my screen right here, daily EM, this is implied volatility. I get this data the day prior at market close and I draw them on the screen. I draw two different data sets here to create a zone. This is RVX daily EM. RVX is Russell volatility, okay? So Russell volatility is an index, right? And if you calculate this, you take the number, the percentage of where RVX is, right? If it closes at 20, it's at 20%. And if you take this, if you divide that by the square root of a year of trading days, which is like 252 or 5 or whatever, you'll get a calculation as far as an expected move. So you can see IWM came into its implied move today, and we kind of rejected from there, all right? This is the importance of implied risk. Now, the reason why I'm calling this out now from a weekly basis is because 75% of last year, 75% of the time, every single week, the weekly expected move was tagged. Every single week, last year, 75%. This year, it was 80%, and then we went 4 weeks without touching it, which is wild. It's very rare. The last time that happened 4 weeks in a row was in April of last year, okay? So it's a very rare thing. So that there's a higher probability of tagging, and the reason I'm pointing this out is because the expected move for this week is freaking insane. So make sure to draw these on your chart to understand that if there's a massive panic outside of the weekly expected move, there's a high probability of coming back in and trading in and around it. And that's to the downside and or the upside. So now you have an idea of where risk can potentially be. Okay? Now let's give you the specific levels. How about that? Let's go to weekly expected moves. Actually, wait, sorry. I'm going to go back to gamma exposure here, and then I'm going to bring up my different software for that. Give me a moment here. All right, so how's the market doing since we reached into 5,700? Here's 5,700 on CBOE. Now take a look. The market basically sold straight off into 5,700 and it's holding up. So there you go. This is the importance to know and understand, levels, right? Levels of high concentration. It doesn't mean you can't crack down and follow through. But what we do look for is a series of higher lows, higher highs, and potentially lower risk to potentially higher reward trades. Simple as that. And then you want market net flow to really kind of confirm to give you an edge. When it's gray like this, you don't actually have an edge in trading, in my opinion, right? So people that use this probably say the same thing. You can have counter trend moves to the divergence, which is currently bullish. But when it's gray, you don't really have the trading edge. You want to trade with the flow, which we always say, right? If you want to swim in a river, if you swim upriver, you're going to have a much harder time. If you swim downriver, well, the flow is going to be obviously a lot better. Okay, where were we? We're going to map out now. I want to go over the SPY weeklies, expected moves, specific levels. I want to go over the Qs, and I want to go over the new monthly levels. So make sure that you write these down, and you can see if price comes to them and how it responds if you haven't done so already. So let's go over here, and we're going to start off with IWM because it's on my screen. So the IWM, it's pricing an expected move up here at 227.96 for the week, 210 down beneath us. For the daily expected move, we're already there basically, so I'm not going to be going much into that. The monthly expected move. So this was based on all the data leading up to the end of last month to look forward as far as risk for this month, which includes earnings risks, election risks. It includes everything that the market sees, right? The market is a discounting mechanism. So it's looking forward to determine areas of risk. And when these levels of areas of risk are, when the market's incorrect, or we get way outside of it, you can see some very, very volatile price action. Okay? So there's the levels there. As far as monthly expected moves on the IWM, we look at about, I'm just rounding it, so 232. You can get the exact numbers if you want, and I post them in the Discord, or you can just take them right here from the screen. And then 203.18. Okay? There's IWM. Let's go to Qs. The Qs. Yeah, we can go over some individual names. So far, everybody, I'm waiting for Mike from ICT to respond. He has not done so. He has not responded, unfortunately. I think that he's just all bark and no bite, unfortunately. All bark, no bite. He can easily come up on here. He's probably watching. The funny part about most of it, while I'm going over these levels, that was Trade Brigade's in here. Hey, Trade, what's up? Hey, man, let's sync up some time. Let's do a video together or something like that. That'd be fun. Or some, I never see like collabs in this space for some weird reason. Like hardly ever. So I think that would be fun, man. Do something, talk markets, whatever. You know, whatever. Doesn't need to be all scripted out or anything crazy. It could just be a conversation about whatever. But yeah, so so what started it all was these people talking about order blocks. And it's so funny to me because even the guy, the creator of ICT, I don't think he actually understands what the order book actually is. So his response, you got to go watch it, man. It's just too funny. So order blocks, by the way, the ICT people often misuse terms. They say things like order blocks, liquidity, sweeps. They misinterpret what actually those things are because Mike, the creator of ICT, slapped these names on various terms, which are actually concepts, which is a general notion or idea. So my point here is when they're talking about order blocks with the context of being a concept of an order block, I'm saying you can actually go and look at a real order block. You can go into literally level 2 data. Watch. Go into level 2 data, and here you go. This is taking the blindfold off. You can see orders in the order book. Here you go. Here's a level that says 40, so that's probably around 4,000. You can even look at the makers, the market makers, right? You have NASDAQ. You have all different kinds in here. OTC markets, all different markets, all right? And then you have them placing orders, okay? ARCA, so forth. It's so funny. So this is the actual auction place, right? So think of it this way. This is the auction place. This right here. Okay, wait, let's add more to this. This is the auction place. This is what comes from the auction place, time and sales. These are printed transactions, okay? And this is your printer. All right? So this is what comes from time and sales. The only time, so candlestick charts is taking auction data. Okay, here's the auction. The auction is recorded, and then it is printed on a chart. This is just, this is basic. And the fact that I just cannot come to grasp that that you don't understand that as somebody who talks about markets. So he'll say something like, I think a fair value gap, which, by the way, let's get this off our screen. A fair value gap, okay? So your fair value gap, first and foremost, ask yourself, what is ICT? It is smart money concepts. Now, ICT is a way to read a price chart to forecast potential price trends and price movements. What is technical analysis? Technical analysis is the same thing. Now, if you want to go beyond a concept and you want to look at actual data to back what it is that you're saying, right? So he said, okay, what did he say? What did he say? This is so funny. And then we'll go over more of the levels. Ah, man, dude, I posted it on Twitter. Where was it? Such a hilarious comment. Oh my gosh. It was too good. Let's go over this. And then we're going to go over the good stuff, the actual important stuff that matters. Okay. Where is he at? Okay. Basically said, you're wrong. That's not what an order book is, because there's always orders above and below. No shit. Like, no shit, right? No shit. That's what a bid and ask is, right? That's the auction. That's the order book. You ding dong. But then he says this, a fair value gap is low delivery prices that are prone to redeliver for efficient delivery. How's that for confusing? That doesn't even mean anything. It does not even mean anything. So funny. Okay, where were we? Let's go back over to the S&P 500 chart. Oh, what do you know? We're kind of bouncing from that 5,700 level that was identified in the early trading session. And what do you know? You go over to Gamma Labs and you see that it is still a very big point of interest. Okay. So there's actual data. This isn't a guess. This isn't me drawing something on the screen and saying, hey, price action traded here. There is an order block, which you can confirm, right? If you look at the order book. No, it was the market reaching down to these lower levels in the first place. Simple as that, okay? And the market came down there, and guess what? As soon as it came into those areas, you can sometimes play these levels as potential areas of support and resistance. Now, the day started off, right, at what? The cash market session starts out at 6:30 in the morning. Now, before the market opens up, or right when the market opens up, I typically post these levels. And these were the levels that were posted in the morning, right? If you want me to verify, I can show you the post at 6:32 a.m. Okay, I'm just going to do it. Give me a second. Wasting my time right now. Wasting everyone's time with this bull crap. Oh, 6:36 a.m., my bad. I usually post it before the market. I got busy. So here you go, 6:36 in the morning. You got 0-day levels, 5750, 5700. Those were the areas of concentration on the map. Okay? Holy moly, right? Holy moly guacamole. All right, let's go back to Qs and now look at the implied moves. Oh, man. Look at this. I made this image. If they only knew, low delivery prices may redeliver for efficient delivery. Hey, dude, if you want to confuse people, use terminology like this. It's called a word salad. It doesn't mean anything at all. Anything. At all. Shit. Oh, shit. I'm waiting for him to show up on my live. But more importantly, why am I bringing this out? Okay, first off, yeah, there are people that, bad characters. I actually truly believe he believes that he's correct. Now, my point is this. There's a lot of people that trade ICT concepts, and there's nothing wrong with that. You can take any strategy and make it work for you, right? Any strategy. Yeah, there's strategies that you don't even need to look at a chart. I know people that just trade the DOM, right? I know people that just look at options flow, right? And structure trades just based off of that, right? I mean, algorithms, they don't look at candlestick charts. They look at what's going on in the order book, right? High frequency traders, you think a high frequency trading program looks at a candlestick chart and be like, boom, 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 bing? Come on, get real. So any strategy you can make work, right? That's not the point. The point is that if you are a new trader and you're hearing terminology of the market, you need to just have a basic understanding of what actually it is. So when I call ICT out, I'm calling out very specifically something that is factual, right? I'm not arguing a concept. I'm arguing that there's actually supportive data that you can look at to determine an order block, to determine liquidity. Not a concept, which is a general notion, right, of that. I'm saying that you can actually look at real stuff, real data, interpret real data. Not a guess. Because the unfortunate thing is there are like indicators for fair value gaps. And if you apply them on your screen, they show up everywhere, right? And here's the thing. Any strategy and every strategy is going to have losing trades. No one's debating that, right? No one's debating that. You need obviously you don't even need a high win rate, right? Win rate is pointless, right? People that say they have a 95% win rate, congratulations, I can do that too. My winners will be really small and chances are your losers are gonna be gigantic. That's what a high win rate is, okay? You're not gonna walk into any real proprietary firm and say, I have a 95% win rate. What they'll do is, okay, cool, dude. Basically, they know immediately what that means. It means that you take wins very, very fast. Simple, all right? So win rate doesn't matter because the reality of a win rate is you can have 9 out of 10 winners, okay? I have a 90% win rate, but you can still be a losing trader. On the flip side to that, you can have a 2 out of 10 win rate and still be a winning trader. So the fact is that people put too much emphasis on their strategy, their buy and sell engine, with not enough focus on their position or their risk management, right? Can I say positioning sizing? Is that okay to say position sizing? I know that word has been trademarked by the Van Tharp Institute in like the 90s. Isn't that crazy? It's true. Look it up. Narratives do not matter. Facts matter, Jeff. Narratives don't matter. Your opinion on the market doesn't matter. What you do in the market is what matters. And you can only control 4 things in the market. You cannot control where price goes, but you can control this. What you buy, I'm not going to write it all out. What you buy, when you buy it, how much you buy, and when you sell it. That is it. That is all you can control. Your narrative doesn't mean anything. You can have a narrative, right? A thesis, cool. But that is to generate a trade plan. And even with that, your trade plan can be wrong. So you need to focus on those 4 things. It's as simple as that. If you're focusing all your efforts on predicting where price is going to go, you're just going to be a losing trader. I'll tell you what, if you want to debate me on this, you show me your P&L curve for the last year. A year, just 1 year. Let's do 2 years. I don't care, whatever you want to show me. If all you do and all you do is focus on narratives because narratives matter. If you want to prove me wrong, then let's look at your trades. Let's look at your history. Let's look at your P&L curve. We'll calculate your Sharpe ratio if you want to do that. All right. And we'll go from there. Other than that, if you're just going to debate for the sake of debating because you have an opinion and a narrative, you're wasting your time. You're going to lose. Because when I talk about markets, I call it as is, right? And then we create a plan, right? That's the disconnect. The narrative is fluff, right? So when I look at this and I said, here's a level of concentration where the market's focusing in on, that's fact. The narrative is I think that price will get pinned in around this area and potentially move because that's what happened in the past. Cool. That's a narrative. Now that narrative doesn't necessarily matter. What matters is how I plan to execute in and around that level, right? So if I go back to SPX, as we did at the very beginning of this stream, that was the first level we called out. You look at 5,700. You take factual data, you create your plan, and you move forward. Simple as that, dude. Argue narratives all you want. You just sound stupid to anybody that does this professionally. Right? I mean, let's be real. People make crazy price targets, and if you want to hear all kinds of narratives, just go on CNBC. You'll get plenty. Watch any ICT video, right? I'm sure that there's an ICT trader out there that actually looks at actual data, that just uses concepts to create a risk ratio on a plan. Cool. But they're not sitting here debating me what an order book is because you can't. There is no debate. An order book is an order book. It's the auction. The bid, the ask, and people in line to buy it at certain prices. And the order book shows you the size of the orders. Right? Yeah, you can use data with ICT concepts. You could. Actual data. A lot of people don't. A lot of people just say order books, or they say, order blocks, and they'll talk about liquidity, but they don't actually show you. They don't back it up. But you're absolutely right. That's why on one of the tweets, Jeff, I stated that if you are an ICT trader, if you utilize a tool such as the order book or bookmap or whatever to actually discuss what order blocks actually are and where they are at what price and what size, they will 10x their performance. So no one's arguing with that. No one's arguing with that. But thank you for proving my point. That's exactly what I'm trying to say here. You can use real data. All right, the Qs. Qs are, let me remove this anchor volume weighted average price. Qs are right back to its week to day anchor volume weighted average price, also known as the daily, because today's Monday. Okay. Q, weekly expected move. What's the market pricing in for the Qs for the week? Risk up here to around 502.65 and down here to around 472. There's a 68% probability, if you think of this in terms of a distribution curve, that we close within that weekly expected move. And there's a higher probability that we tag these expected moves. Now, the thing is here, the larger the expected move, the less likely that we typically are to tag them. But I wouldn't rule it out because we do have a lot of stuff going on. Now, this expected move is frigging gigantic, right? As pointed out prior on the S&P 500, we haven't had a week this big of implied volatility. So it's big. Okay, the monthly expected move. What's the market pricing in for the month? Well, we got 512.50 up here. We got 455.18 down there, okay? There's Qs. Now let's go to SPY. Let me take another sip of my coffee too. We're coming up back to daily volume weighted average price here. And by the way, if you want to know what market conditions are right now, I'll explain what market conditions are currently and how I approach them in this current environment, okay? And this is also factual data. This is what happens, and I'll prove it to you, right? I'm sure that a lot of these ICT people know what VIX is, right? For the most part, like, does any ICT trader in the chat, do you know what the VIX is, right? Can you confirm? It's the volatility index, right? For the S&P 500. All right. So we'll go over market conditions in a moment. And I'm going to show you something that will blow your mind. that you cannot see with an ICT concept. I'm going to show you actually a legitimate smart money data. I want to show you because this, I mean, they'll look at this from a vol fund perspective, vol traders, right? This is incredibly important. Okay, perfect. So people know what VIX is. Thank you. I'm going to check here. I'm going to just see if he's responded, if Mike responded at all from ICT. Nope, he hasn't. I'm looking at my email. I'm looking at my DM. He has not responded. He is the one that offered. He is the one that offered, but is not there. This guy saying, I do grind ICT. That sounds very questionable. I grind ICT. Okay. You know, catch me in the club grinding on ICT. You must be very unprofitable. To be named Figuring Out Money, all you do is the 2020, all you need is the 2022 ICT mentorship. I don't think this guy, Nutty Plays ICT Grinder, realizes that you can just verify my performance right now from a year-to-date basis on the United States Investing Championship. Or you can just look at my P&L curve that I post. I don't get it. Let me ask you, does ICT actually, is he in a trading competition? Does anybody know? Right? He talks about the Robbins Cup frequently. I trade equities, by the way. I trade equities, so I don't like, you know, for sure, no. I'm going to repost this. Give me a second here. I want to repost this guy, ICT Grinder, the guy that you can find in the club grinding on Michael. ICT Grinder, here we go. I'm gonna go ahead and do this, and we're gonna talk more about these levels, okay? Let me just post my P&L curve, and I'm gonna post a link to the United States Investing Championship website. And if they want to, this is 1 year P&L curve. You probably just heard that. That was me screenshotting. Let me go back over here. I'm gonna post this, and then I'm gonna go ahead and go to the USIC website. And by the way, I just started doing that. I did this last year too, but I actually pulled out. I was up 30% and then bought a house. So I pulled out my entire account and then restarted it up. But you could see that data. I'm sure that it's verified somewhere. But now I'm doing it moving forward because if I'm going to talk about markets, I'm just going to show you my performance. I'm not going to sell you an alert service. That's not what I'm going to do. But I'll verify my performance. Now, I'm never going to win, and I know that. I'm never going to win the ICT. I'm never going to win the United States Investing Championship because I do not use leverage. I don't trade on heavy margins or anything like that. I'm not going for a 400, 500%. I'm trading my real account, my real money. And the minimum buy-in for this event is 20K. That's minimum. I'm trading over 200K. Let's just say that, okay? I'm trading over $200,000 of my own money through multiple accounts. The one that I'm trading here more specifically is 2 separate accounts technically, but one is being recorded. Okay, give me a second. United States Investing. How do you pull this up? United States Investing Championship. Does anybody know if he's in there? Is he on the leaderboard by any chance? I'm sure that eventually he's going to make it to the leaderboard, right? I would imagine. I mean, he knows the algorithms of the market. He knows. He knows. He knows. Okay, so just so you know, I'm up. Here we go. And this isn't to brag, by the way. This is just me. I'm just getting verified. I'm up 46.8% year to date on the last recording. That doesn't include this last month, which will go in. I played very light this last month. But this is also almost 50% up year to date, and this is not using leverage. It's not using margin. It's very low risk stuff, right? Okie doke. Okay, give me a second. Sorry, I'm gonna pull up my Twitch stuff too. What's your name, Mike? Yeah, no, my name's Mike. My name's Mike. The other guy on ICT's name is Mike too, MS. Yeah, facts don't care about the narrative. Also true. Facts don't care about narratives. You want me to send you the script for the trend changer? Okay. Are you in Discord or no? Let me figure out how to do that. Oh wait, no, I have it on the trend changer is this right here. So the trend changer is something. So I saw Brian Shannon, a professional trader who's been doing this for 20 plus years. He posted a visual of kind of a chart that looked like this. And basically it was just showing the direction of the 5-day moving average when price is below it, right? We're going to talk about market conditions here. And you know, it's very simple. When you have a declining 5-day moving average and price is below it, stay away. It's simple, right? You want to not be the person to try to turn price. You want to trade when price is in your favor. It's as simple as that. Or you look to short in these environments if it makes sense to. So this is the trend changer. Basically, I saw him post it and I was like, oh, I kind of like that. So I just had a script written for it, right? That it was easy. It took me 5 minutes, 10 minutes, maybe 15. I don't really know. There was actually kind of bugs in it and then I figured it out. But it came from just me seeing him on Twitter do it. So I don't know what he calls it, by the way. So I just call it the trend changer. So he might have a name for it and he has his code. It's probably the same because all it's doing is shading so you can just get a visual representation. And if you want this code, I didn't share it on TradingView. I did within like my community, but I do have it on Thinkorswim, and I've shared it there. So maybe if you just reach out to me on Twitter, I'll repost it, okay? And so you can have it there. Because I gotta. If it didn't work, I gotta figure it out for you. You know, I don't really know. Okay. Okay, so let's talk about market conditions. This is where it gets very interesting. If you want to actually understand a real, something to do with smart money, right? Smart money. If you want to really get, learn how to take the foot off the gas when it's necessary, pay attention. This isn't a concept, right? This isn't a concept. This is legitimate. This is how dealers respond in various market conditions. Now, if you have a trading strategy, you got to understand what conditions the trading strategy works in best. Right? So if you're trading, like I like to trade breakout, like I'm a breakout trader or speculator, right, of breakouts. So I'll enter in prior to thinking that we're going to be breaking out and I'll pyramid in. Okay. I know the environment that works good in. It's when we have an inclining 5-day moving average for the asset and even for the S&P 500, the largest market out there, right? The SPX. Okay. Above an inclining 5-day moving average. But more importantly, it goes deeper to understand this. And that is where gamma comes into perspective. Now, there's something called the gamma flip line. So if you look at a chart of net gamma exposure, you'll see blue lines, you'll see green lines. In short, you accumulate all the data, it spits out a number, and this number depicts whether you're going to see increases or volatility or not. So let me explain it. The current gamma flip line is at 557.88. Now, there'll be other services that are in and around there. I find it to be more of a zone myself. But let me go to gamma levels and let me draw it on the screen here. Bakum. Here you go. This is the gamma flip line. Now, where is price? Price is below it. Okay, when we're in negative gamma territory, what do dealers do? I know people know this because I talk about it on every brief. But the people that are here that do not know what negative gamma is, or gamma exposure, or market conditions, pay attention. If you actually want to learn how markets operate, right? If you want to learn the operation, like I haven't drawn out any support or resistance yet at all. And I've just been talking about levels that the markets are focusing on through data. That's it. That's it. The gamma flip line is right here, right now. It's dynamic. It always changes. It always updates. I look at it at the close of business and in the morning. When you're in negative gamma territory, this is when, and I'm going to show you a chart of the VIX. You're going to be blown away. I'm going to show you a chart every time we go into negative gamma territory. Okay, here you go. Here's what it looks like. Let me go to net gamma. Where are we at? Time series, net gamma. No, yeah, net gamma. Okay, so here's a time series where basically, today is, right here, and then you go back through history all the way to July. And what you'll notice here is the green is when you're in positive gamma territory, above the line. When you're below the line, it's this blue. Okay, so green, blue, green, blue, green, blue, right? We're negative gamma territory right now. Now, you might think, okay, why is that necessary to know? Okay, When you're in negative gamma territory, and I'm going to prove it for you, when you're in negative gamma territory, dealers, they sell into selling. They buy into buying. This is hedging activity. So what happens when you get selling into selling and buying into buying? You get much more aggressive price swings to the downside and to the upside. Volatility increases as liquidity dries up. This isn't to debate. This is a fact, okay? It's not a debate, it's a fact. You can look it up yourself, right? So there's no point to debate that. Now, when you're in positive gamma territory, when you're above the gamma flip line, dealers, they buy the dip, they sell the rip. Now, what does that do? That decreases volatility and liquidity in the markets increase. Now, you might be saying, well, prove it. How do you prove it? I'm glad you asked. I'm glad you asked, my ICT friends. I'm glad you asked. Let me show you the most powerful chart that really just bundles this up in a way that you can visually see what I mean. All right? Let me go. Today's we're in negative gamma territory too, so let me edit this and activate this drawing and draw it out more. There we go. Okay, now I'm going to go over here. I'm going to show you more data, okay, because we like data. I'm going to go, let's go 1 full year. No, I got to go more. I think I have more data in here. Let me go 2 years. Okay, there we go. Okay. All right. So as I've shown you, do you see the times that we went into negative gamma territory? Right? This is back in July of 2023, basically to November 1st. And then you have multiple little spits of negative gamma territory, bigger areas here. When I say volatility increases when you get into negative gamma territory, what am I highlighting on my screen? The asset that I'm pulling up is the VIX. This is the volatility index of the S&P 500, ladies and gentlemen. You can pull up VIX futures, by the way, if you want to do that, because VIX futures, in my opinion, that's probably what people should be looking at, but more people know the VIX. Okay, when the gray box turns gray and when it turns out, this is when markets move into negative gamma territory. And what you'll notice is, what happens when we go into negative gamma territory? Volatility increases. Oh my gosh, look it. It went into negative gamma territory on July 18th. And guess what? What happened to the S&P 500 after July 18th? July 18th was right here. We went into negative gamma territory, and what took place after? Now, you can't predict how much price will go down and how high volatility will go up. You don't have a control of that. But what you do have control of is what we talked about earlier on this stream. If you know that you're in negative gamma territory and you know volatility is going to increase, you can dictate how much your portfolio would move in such an environment. For example, if you trade a $100,000 portfolio and the VIX is at 10, but all of a sudden the VIX shoots to 20, one thing that you'll expect is you're probably used to daily swings with the VIX at 10. But now, because the VIX doubled, you are now going to see daily swings of twice of that. So instead of trading with a 100K portfolio with a low VIX, you now feel like you're trading with $200,000 portfolio, but you're not. You are just trading in a much more volatile environment. To my point, if you want a P&L curve like I have, you need to be able to take your foot off the gas in times of turmoil. The turmoil, as far as the market conditions go, I look at two things. Negative gamma territory. So when we're in negative gamma territory, guess what works really good in negative gamma territory? Day trading, because you get much more bigger price swings back and forth, right? So like, for example, we talked about, we're in negative gamma territory and we talked about 5,700, right? Look at the big bounce from 5,700. This is that, that's what happens in negative gamma environments or under the flip line. Okay? Now, So it's under the gamma flip line. And then the other thing I watch for, which once again was the direction of the 5-day moving average. So if it's declining, these are two things that tell me that the type of trading that I do, so my main bulk is swing trading, right? So swing trading, breakouts and stuff like that. It tells me right out of the gate, hey, Michael, you're going to experience more fake outs, more shakeouts, more whipsaws. So guess what? Take your foot off the gas, manage the trades that you have currently on, and look to add exposure on A+ setups. But if it's not, and if it is an A+ setup, make sure that you go in with the notion, with understanding that your position sizing should be different in this environment because volatility has increased. Then when that environment changes, guess what? You start to add back exposure and you put your foot back on the gas. Boom. Don't even explain VVIX. I mean, should I explain VVIX? The volatility of volatility? I mean, right? Like, I guess, yeah, you're basically saying don't even bother. Right? $4 a month. Oh, wait. Jeff, do you think 4% a month is not a lot of money? I'm confused. So for example, like, okay, yeah, maybe if you have a $100 portfolio and you make 4%, it's $4. But if you're trading $1 million, it's a little bit more, right? So the percentage thing, it's important to focus on percentages. But if you're a profitable trader and you're making 4% a month, you can make a lot of money in a very short period of time. Like, so for example, the best traders in the world don't even do that, right? Like look up the biggest well-known that have a back of history. They're like 20 to 30% a year for 30 years. If you just make 100% in a year, you're dumb. Like congratulations, you had a year that was up 100%. But the problem is you can have a month that's up. Here, let me do the math for you, dude. Let me do the math for you. How about that? How about this? How about we'll just pull up the calculator. Fucking people are dumb, dude. Give me a second. Let me open this up. A boom shaka, boom shaka, boom shaka. All right, you tell me how good a year is. You tell me the balance and you tell me the year. I'm waiting. I'll wait. I'm gonna prove my point. I'll pull up market stuff here in a moment, yeah. Here, let me just put it this way. You can make 100% in a year. There you go. There's your $200,000, right? So you went from 100 to 200,000. Congratulations. Let's say you went up 50% the next year. Go 50% the next year. Now, first and foremost, what you don't understand here is to make those type of gains on that type of balance, you are risking a lot. So if you're making that much, you can lose that much if you're not managing risk properly. So for example, you come up to 450,000 here. That's 3 years. Congratulations. That's great work. So what happens now if you have a minus 60% year? You have 180,000. So your CAGR is 15% per year, which is less than 4% a month. Ding dong. Gosh, people are dumb. Jeff, much better results are always possible. No ding dong, no heck. Like no shoot, right? We know this. Much results are always better. But the results really dictate on the risk. So you have to understand risk, right? So if I put all my money into one trade and it made 200%, and by the way, thank you for commenting and thank you for being here. I know you're not, I mean, I wish you were learning something because I am showing data that supports everything. Like this is, I showed a calculator, right? You can't hide from math, right? I showed I show gamma, like I'm not making it up, but I'm just showing you actual data. So far, you haven't really provided any insight, anything, but that's just ICT, right? That's just ICT. So, I mean, and that's fine. If you want to get better, but the people that are the loudest are the people that don't make any money. That's just how it is. Quiet people make money, right? And if they're loud, they can back it up, right? I'll get loud. I'll get loud about ICT stuff, incorrectly misusing words and terminology about the market any day of the week, because I can substantiate it with facts, not narratives, which you just said are more important, by the way. Now what, boy? Now what, little boy? Little ding dong. Okay, let's go into the market. Let's see what the market's doing, and then we're gonna look at individual names. Pedro. I'll put Pedros. I'll post the trend changer stuff. Why am I slamming kids on Twitter? I'm just having fun. But I do like so. I honestly think that if you come into this with a level mind, if you actually are trying to learn ICT because you want to do better, congratulations, welcome. Like, that's awesome, right? But always look at other sources of data. Like, you got to question it. If you're not willing to question it, to understand it, or even what it is that you're learning, which is a concept, and if you don't even know what a concept is or the definition of a concept, what are you doing? What are you doing to yourself? It says it on his YouTube page. A smart money concept. People, it takes 5 seconds to look up the definition of what a concept is. My guess is it is what I said, an idea, a general notion of an idea. Right? Thanks, Jag. Or, sorry, I can't remember something. Pretom. So, I mean, here's the thing. Like, dude, if you like ICT stuff, cool. Like, nobody cares. Nobody cares, like, that you do ICT. ICT is just another form of technical analysis, of reading a chart. It's to forecast potential price moves. That's what technical analysis is. That's it. But if you want to understand the interworkings of a market, you're not going to do it on a candlestick chart. You're just not, because you're already behind. I know that the key indicators of a market is price and volume and volatility. Price, volume, volatility. But you got to understand how this comes about. The auction place. What's the auction look like? What are the spreads? Where can you identify levels of interest? Not printed levels, but where are people focusing into the future? And that can be seen visually. Take your blindfold off, right? Take your blindfold off, and you could look at the order book. It's there. You do not need to use the order book to be a successful trader, right? I don't use the order book to place swing trades. I don't, because I don't care about the intraday levels there. Like, I don't, right? I don't need that to be a successful swing trader. But if you are day trading and order blocks are important to you and sharp movements are important to you and you're intraday trading, you sure as hell have to be looking at gamma levels. You need to look at market net flow for the day. You need to understand what side of the market you're going to be on. And if you don't, then guess what? You're just giving up literally a cheat code, because that's what this is, cheat codes. It gets you on the right side of trade. It lets you know what dealers are doing. It shows you literally the cumulative net premiums. This is market net flow. Gamma exposures tell you where the exposure is for the market. You don't need to guess this. This is legitimate data. There it is right there. How did we know 5,700 could be a floor? How do we know? How do we know it has the potential at least to be a floor? Because you don't know for sure if it's going to be, but how do you know it has the potential? Because that's the concentrated area. Woo! Okay. All right, so we saw a little bit of a bounce into the volume weighted average price here on SPY. If you want the weekly expected moves on SPY, we're looking at 586, the upper weekly expected move, 556 to the lower expected move. Okay, and then we had the monthly expected moves, so the market's pricing in as far as risk goes for the month, a level up here at about 597 and 539. Now, let me be quite frank here and tell you that the market is, the market's looking pretty crazy here. If you've been watching the 10-year yield, it's been absolutely bonkers, right? We've been seeing a massive, massive move in rates. So market is a discounting mechanism. So what does the market see and what is it pricing in that we don't? What's the dollar doing? Let's take a look at the dollar. The dollar's, why does it show that it's up, but it's down? Dollar went on a massive run. It's kind of coming in a little bit today. All right. So what was the market pricing in heading into this election? And are they going to be wrong where, are they saying that, yeah, no, this is what the market's pricing is, a big dollar movement? For what reason? That's where narratives come from. And if they're wrong, is the dollar going to come right back in? And if the dollar comes right back in, what assets does that help? Historically, a falling dollar helps out various commodities, right? If you look at intramarket analysis, you can look at currencies. Currencies can typically lead commodities, right? Commodities can typically lead bonds, right? If you look at a chart of oil and the 10-year yield, I can prove this to you. I shared it before. And then it comes the stock market, which is the last of the group. And this is all, you can go research this, right? You can go look at somebody like John Murphy, right? Martin Pring, that do his great work around intermarket analysis, right? Do I give these levels for the Dow? I did for DIA. I don't really trade the Dow. So, and it operates a little bit differently. So the DIA, it does have these weekly expirations. I'll give you it for DIA if you like that. The weekly expected move for DIA, which is the diamonds, it was plus or minus 1049. Okay, the market closed on the DIA at 420.42. The upper level is 430.91. 430.91. The lower level on DIA this week is 409 and 93 cents. Yeah, no, it's not full of myself, Jeff. I think you just have a big bias, and you're very emotional about it. I'm not. It's not being full of myself. It's literally just stating, and everything that I could say, you can go look up. Right? You can go fact check it. But to call me, full of myself, and then your leader, Michael, what is he? If I'm full of myself, what is he? The problem here is you just simply put are very biased, and you're not open to learn. You're just open to be a critic because it goes against your narrative. And that's how I know you're an unsuccessful trader. You're not a successful trader. You wouldn't be here if that was the case. Sorry. Successful traders don't act like you. They don't. Simply put, go ahead, on X, go ahead and post your results. Let's get it verified. Simple as that. Let's shut you up right now. Shut me up right now. I know that you're unsuccessful by the way you're acting. That's my narrative. That's my guess, because I can chart these emotions, right? So prove to me. Show me. Now, I don't want to see like, oh, I made this much on a little payout, right? When you're not even part of the order, but show me the last year of your trading. Show me that 4% a month doesn't matter. Show me 2 years. How about that? I mean, you seem to know everything. Post it on X, tag me, and I'll repost it. Let's see it. Why argue with me if why haven't you done this already? And then explain what it is that you do. You can explain what you do and be a successful trader, but it doesn't take away from everything that I said. I'm just providing you data that can be fact checked. So, but I appreciate your engagement. I do. I'm glad that you're here because you could be on somebody else's live stream just talking about ICT. So that's step one. Step one is that, right? This is a step. There's multiple steps to denial, right? This is like the step one, right? I'm waiting. I don't see any tag yet on X. I'm literally waiting for you. Are you going to do it or no? And I still, by the way, apologize, but I do not see your ringleader, right? I don't see Mike coming out and joining the live. He hasn't reached out to me via email or X. Once again, he said that he would battle me or go back and like I don't know what that means, You the only competition while you trade is yourself. So but if he wants to talk about markets and analyze markets with me on any time frame, we'll do that. But he coward. He's a coward. He didn't show up. As soon as he said it, I said, I'm going to go live today. Tagged him. He's not here. So go on X, show me your results, and then tag the guy, tag Mike, tag ICT, and tell him, dude, we're waiting for you, man. He's talking crap. Go shut him up. Go prove him wrong. Go prove to him that you know exactly what's going to happen in the markets, and it's all controlled by a single algorithm. Even though when you look into level 2 data, you see orders from a bunch of different marketplaces. It's one algorithm, people, though. It's one algorithm. Come on, I'm waiting. I will wait. I'm waiting patiently. Still haven't seen anything. Ding, 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 dong. Okay. Let's look up some individual names. Oh, my leg, dude, it's falling asleep. I feel like there's going to be some sort of ICT trader there that can show not like a payout, but like actual like he used his own money in a real market and shows proof of trading. Like that's fine. I'm not saying you can't be a profitable ICT trader. What I'm saying is if you're going to talk about market structure, do it correctly. Do it correctly. You don't need a concept. You can look at actual legitimate data. The hell do I need a concept for an order block when I can look at level 2? Why do I need a general notion or idea? If that's good enough for you, then cool. But don't misuse market terminology, especially if you have a large audience, because what happens is they turn into, what's his name? Jeff 1998. They turn into him. Rigget, hey Mike, since you haven't replied, I am guessing you don't want to build your platform. What platform, man? Oh, I kind of remember. I just don't know what I want built. Rig T Trader, but I do appreciate. I just don't know what I want built. So I thought about that, and I appreciate you reaching out, but I really don't know. You know. Like I have no, like I use, like I'm actually in talks with Gamma Labs right now to just kind of partner with them because they have a great platform already. He probably is a cool guy, Jake. He probably is, and he probably wouldn't act like this in real life. But you know, people act like this on the internet all the time. Maybe he's not a cool guy. Maybe he's just one of those people. Like you always have a friend that just like loves to argue for the sake of arguing. I have a friend like that. He's hilarious. We'd love to just like it's always devil's advocate, you know? Like it doesn't matter if it's true or not. Our opinions override anything, right? It's just what it is. It's hilarious. Yep, order blocks, just supply and demand. You're right. It's supply and demand. That's what the marketplace is. That's what you go into level 2. You can see blocks of orders, especially down here, right? Look at this, 417-ish, right? There's a lot of orders down here. 417.50, right in and around those areas. That's a lot of liquidity down there at 417 on the DIA. All right? So there you go. Like I'm looking at visually order blocks down here. Like I didn't even need to look at the candlestick chart. I can tell you where real data is, real orders. Go to SPY. And there's software called Bookmap, right, that paints this stuff. So look at this one. So 40, which you know, if there's a 1, it means there's 100, right? There's 100 orders. If there's 40, we're looking at 4,000 at 570.20. Oh. Just got pulled. There you go. Oh, no, there it is. So if I were to pull up Bookmap and look at like the visual representation of that, I can tell you there's 40 orders, or 4,000 right around these areas. And it's not even a guess. It's just, that's just what it is right here on the current tape. All right. And like I said, you don't need that data to be a successful trader. You don't. But if you want to talk about like orders, then yeah, then you do. I don't know how to like beat this dead horse up. Like that's just what it is. Like that's truth, right? Okay. I haven't used Sierra charts, but yeah, Sierra charts are great. However, it's just so hard for me to learn new platforms, and Sierra charts, I hear, is probably one of the harder applications to really get the hang of. So I'm open to using it and looking at it, because there's a lot of platforms that software that uses that you can integrate with Sierra charts versus some other stuff that I use, and I'm like, dang, that's probably worth it just to do that. I just haven't yet. Yep, exactly. It's just a tool you use. No, man, who cares? That's all it is. Okay, let's look up some random charts. If you want to pull up the individual names, look at. I mean, I don't have much more to say about that. I don't think the guy from ICT is going to show up. We had one ICT guy show up, but he's just you know, I don't know. Just in a bad mood, I guess. He's grinding. He's grinding ICT. ICT grinder. Thanks, trader. I appreciate that. Is Bookmap useful for swing trading? I mean, you can get some levels from that, right? But in my opinion, I don't need it for swing trading. I don't. For swing trading, I like to look at larger time frames, and I like to look at trends, and then, right, just price action. I like to look for contracting, whatever pattern, I don't really care. But I just look for being in a positive trend, and I look for price action to contract, because when you see price action go from expansion to contraction, which all assets do this, they move from periods of expansion to contraction, I then look to back into risk of smaller areas, and then I trade it. That's it. And I hope that volatility expands in my direction, and if it doesn't, I have a clear level of risk. Okay. So this guy was like, all you need is 2022 ICT mentorship. And I responded, okay. And I responded with, okay, with the financial competitions link and then my P&L curve. And he was like, congrats, but I got nothing to prove. Nice going though. Because I said, you next. I've got nothing to prove. But what are you talking about? You got nothing to prove. You're trying to prove that ICT is all you need. Of course you have something to prove. You're trying to do it. Yeah, I kind of think it's more better for day trading if you want sharper movements, in my opinion. Okay, drop some tickers in the chat. Let's look at some names. Exotic. I'm okay with that. I know you're probably right. I'm probably just talking to a bot, an ICT bot. I'm just like going back and forth. All right, we'll look at Costco. All right, we're going to pull up, 5, 10 names, and then I'm going to call it quits. I don't think this dude is showing up. Hey, I swear to you, if I get off of this live stream and then all of a sudden he reaches out and says, where are you? I'm going to hop right back onto the live stream. But I have a feeling he's that type of guy, I have a feeling that as soon as I get off, he's like, oh, what, you're off now? Right? I just saw this now. That's who I'm dealing with. Okay. Okay, we got some good names coming in here. Okay, Costco. You have plenty of time before earnings, so you can make definite trades leading up to this. I don't like to initiate trades going into earnings, obviously, because the IV swells like a puffer fish, okay? Overall, what do you see? I mean, cost goes up, right? We're holding a series of higher lows. Okay, actually that's a lower low. But we're kind of just consolidating here, building out a base. The last base over here looked real clean, right? You get this gap down, but price action kind of just tightened up into this small range. And it was when the 20-day was actually curling back around and we got back above the 50-day, okay, which was flattening to inclining. Now, the difference here between that base and this base currently is where's the 20-day moving average? Well, we're currently below that, all right? And you're seeing a series of lower highs in the very short term, right? And just one lower low. So in my opinion, for something like this, if I want to execute into this, the first question is where can we potentially put our risk? Well, if you go long, say right now, well, an ideal stop would be just under this low, right? I mean, that's the obvious spot because you wouldn't want to hold it if it's going to continue to create more lower highs and lower lows. So what I personally would like in a setting like this is you can see that there's clear hang up right in and around this 900 level, 910. You can see that this big kind of rejection candle here took place. You can see that over here, right? How we gapped up and closed at the lows. So right in this area. So what I would prefer to see is price to reclaim some of these averages, to tighten back up and offer up a better risk to reward, like something like that. So if I want to do it a little bit more shorter term, you can look at the 5-day moving average and you can see that right now it's yellow on the trend changer, which means what? It means that the 5-day moving average is currently declining while price action is above it. Okay? As price action was heading lower, if you want to execute into something like a declining 5-day moving average, you could have looked for something like these little positive divergences or something like this, right? And then you created a potential plan once you see strength and you have an idea for a stop loss, all right? So what would be what I would like here on the shorter time frame, whether you anchor volume weighted average price to see where that goes to and use that as a level of risk. But what I would like to see is this to flatten out, start averaging out some of this data in the past, flatten out, and turn back up. So I would like to see it come in, maybe undercut it, and provide a series of higher lows in the short term, and then buy into the strength to offer up a potential change in trend at the beginning of a potential change in trend with identified risk levels. So that's how I'd approach it on the smaller time frame. Okay. NVIDIA. Okay, yeah, NVIDIA. Yeah, Glenn. Yeah, exactly. If you want to learn how to trade and you want to learn about markets, then do so. Right? There's no arguing that. You're absolutely correct. But you seem like a level-headed person that likes to use ICT concepts. Right? I think you can understand, like, if somebody tells you, like, hey, like an order block, like you can come to the conclusion of what an order block is by actually looking at the data. And you understand the difference between a concept and what is actually true. And you can decipher, like, okay, do I need to look at the true data or can I just operate on a concept? And that's not the right or wrong thing, right? That's just you having a level head. But if you're going to tell people that if you're going to tell somebody that they don't know what they're talking about, and you're calling out an order block, but you have no idea of the size of the order block, where the orders actually are, to the cent, where people are transacting at, then it is a concept. It's a guess. That's just fact. It's just fact. You can't refute that. The only thing you can refute is how you trade it. So once again, you don't need to know the data to trade that, but it is available to you most of the times for free. It's as simple as that, right? There's always going to be orders above and always orders below. Cool. No shit, right? There's a bid and there's an ask. And then that's what makes a marketplace. Bids and asks. Go to level 2. If you want to look at big levels, you can find them in the order book. You don't know the size of the levels above us and below us and where the key areas of concentration are unless if you pay attention to that. That's it. Okay. So there's Costco. Let's do NVIDIA. NVIDIA recently got told that it was going into the Dow, right? So it's up a couple percent on the day because of that. And maybe because of that. All right, so a couple percent. And I think, isn't the Dow getting kicked out of the Dow? I got to look up the news. I could have sworn that was the case. NVIDIA overtakes Apple. Yeah, bolstered by the inclusion of the Dow Jones Industrial Average. So who are they removing from the Dow? I could have sworn that they're removing Dow from the Dow. The irony. NVIDIA looks still fine, right? It is what it is. I mean, a series of higher highs, higher lows. All averages are stacked in the right direction, trending up. Is there a trade right now to be executed? Not in the daily time frame. Once again, I would prefer price action to tighten up, kind of like how it did here, and then also here on the larger scale. So when I talked about it, it was more over here, and then also this larger structure. All right. So now you just be patient. You wait to see how price sets up. Where are we on the 5-day moving average? It's declining. So I don't want to see it start to flatten out and start to turn back up and carry on, or gap up, come in and do whatever. But I would want to see this inclining for me to kind of really execute. And if it wasn't like this, I'd be looking for extensions to the downside to offer up, smaller like bounces, right there, right here, right? This was a little expansion, contraction. It offers up low risk to potentially greater reward. What am I listening to? Some groovy jazz. Okay, got a meme going for you. You got a meme going for you? I've never traded any. Oh, I think I traded Shiba and Doge before, a long time ago. They're removing INTC. Oh, and Dow. Okay, thanks. INTC is getting axed. Got it. Glenn, you can just post a trading view chart, or like whatever. You post a trading view chart, and you can post the link in here, and I can pull it up if you want me to do that. Glenn, if you want to show me something on a 5-minute chart. You can show me whatever, like support, resistance, and fair value gap. That's not what we're talking about here, really. I mean, you're the fair value gap, right? So your 5-minute chart, for example, like what I'll say to that is, cool. Once price action reached down into whatever area that you're talking about for the fair value gap, I can just go back to here and tell you that I pointed this level out before the day started, right? You can't do that with a candlestick chart. You can go back through past data and say, hey, this was the level of interest over here. But this is actually data leading into the day, right? This is where concentration is. And concentration can change. As you can see, it hasn't really changed. 5,700, and then we're starting to actually get up to 5,745. So that's actually starting to grow here. So yeah, that's another 10 points higher in the SPX. So is the market going to come up here? And if it does come up here, what is this telling me? Well, this is the call wall for the day. So if you're wondering where price can go to, and potentially get hung up at because nobody's really reaching out further than that, it would be 57.45. So 57.45, 57.50 would be kind of a cap side on this current rally, or has the potential to be cap side on this rally because the data supports that, right? And I'm not even looking at a candlestick chart to say this. I'm just showing you what the marketplace is doing, not just like, prior data. So you can use either way you want. It don't matter. Let's look at some other names. So if you want to post your chart, yeah, I can pull up your chart. That's fine. But I'm trying to wind this down because I don't think the ICT guy Mike is going to show up. I think it was all bark no bite. But it is what it is. If he showed up, man, that'd be cool because we could just sit here and talk markets. I'm not going to sit here and argue with him. I'm trying to understand what he's saying, but then I'm going to provide facts of other data. I don't think he wants his audience to see that, to be quite honest, because somebody had pointed out that he's done this multiple times, asking to go compete on a live stream, whatever that freaking means, compete, right? Like who can predict what? Predicting market movements, it doesn't matter. Forecasting movements so you can have better risk management is what matters. NVIDIA, okay, we got, this was fun. We got a lot coming in. So CEG and Carvana. So this one took a big hit today. So on earnings. So what happens here is weak stocks typically get weaker. Now this is in a bigger, uptrend, right? Above these rising 200 days, a larger one. But on an earnings move, now what I like to look for is consolidations. Now, for example, like I don't touch this on a big break on earnings because typically weak stocks once again get weaker. That doesn't mean we can't see a bounce, right? This is what I call a pullback, right, from earnings. And I look for this all the time, right? More importantly, I look for it from the bullish perspective because I'm primarily a long-sided trader. So I look for a big bullish earnings move and I look for price to kind of consolidate. I look for volume to dry up and I look to play into a continuation of that. So on CEG, I just let it go. I wouldn't be touching this because I'm not interested after a large gap. So if anything, I would be looking for it to see how it consolidates and sets back up to see if there's any opportunity here. So for example, I can go to Intel, right? Intel, you can see we had a lower low, positive divergence. And what did we call out kind of in this area? Well, you see, I got to pull up the original trade idea, but you can see, even right now, actually, it is starting to, after this big earnings gap, we built this base, saw a little bit of a positive divergence, and now it is actually, price action is getting pretty tight here. So let's actually activate this and I'll show you what I mean by price action coiling up. So right now, as price is kind of just jubilant around, it is in an overall downtrend after this big gap, but if we start to see breakouts of this level, 24-ish, you have a clear idea of where risk could be and potential reward, right? Now, me personally, when I look at this, it's like if I'm going to trade a stock that's already below a declining 5-day moving average or 200-day moving average, my position size is going to take that into account, and the way that I approach it as far as a risk management perspective, like getting out of the trade or scaling profits, is going to be a lot quicker than something that was in more bullish conditions. Let me give you another example of what can go wrong on an earnings move. Notice here on Lululemon, we got a bearish earnings gap, price consolidated, and people got very excited, like, hey, here's a good opportunity. Well, unfortunately, it went down lower, right? And then price action started getting pretty tight here, and we started breaking a little bit of a trend. And I traded that. But during this time, I traded it, and I'm very clear, like, if we get stopped out, I get stopped out, and I move on. But on the run-up, I'm very quick to absorb my profits and move my stop loss up because the overall trend at the time was down. Then you fast forward to where we are here, you get through earnings, you're starting to see a series of higher lows, all right? And you start to see the 50-day moving average start to curl back around. So now Lululemon looks a lot more positive from the shorter term, but you're still fighting a larger trend to the downside. So even if Lululemon spikes up here and the 200-day is still declining, there's a high probability that we pull back in and set back up for a larger base if the market wants to start really moving into a stage 2 markup. All right, there's 4 stages of market structure: accumulation, markup, distribution, and decline. 1, 2, 3, 4. You can go to any chart and see this, and you can see it on multiple time frames because it is fractal, right? You can go to ARK, right? ARK, A-R-K-K, go to the weekly time frame. 1, 2, 3, 4, boom, right? And now what? Now I'm looking to see if it's actually about to move into a stage 2 markup, right? There's a possibility that this is accumulation as some of these averages are starting to turn back around. So it gives us the higher possibility and potential. It doesn't mean it's for sure, but if we can start breaking out of these levels, it gives us a high chance of this being a base and a breakout to be a potential markup phase. And if that's the case, that's where a lot of money can be made. And you can trade around those positions. All right? It's all about potential and opportunities. It's not about like predicting. Like there's no point to say, hey, the market's going to $55 here on ARK. Like no one knows that. You can't control that. Unfortunately, you don't control that. You can only control what it is that you're buying, when you buy it, how much of it that you're buying, and when you sell it. That's it. That's all. So let's keep going on. I did see Carvana. Yeah, so back to the earnings stuff. This is what I like to see. I like to see big bullish earnings moves, and then I look for the consolidation. So see, big earnings move, obviously on big volume, that's obvious. And then you're seeing the consolidation, the pullback on lower volume. So now I like to see how price kind of shapes up in these areas, right? So for one, you can go into like a smaller time frame, like a 5-day moving average right here, and say, okay, it went down into an inclining 5-day moving average, clear trend to the downside, right, in the short term. But if we start putting in a higher low and we start changing this structure, that could be the potential of the continuation of this bullish earnings gap. And you could get more tactical with this. You can go into, let's look at side by side in multiple time frames. We'll go into Carvana. Okay. And you could look at this here on the 30-minute time frame, and I can apply an anchored volume weighted average price to give us levels of interest. So I go from this swing high, and you could say, okay, it's up here. So if we do all of a sudden get a snap back up, there's a high possibility that price action could interact in this level, because this is the average volume traded since this market high. It's a level of interest. So if we do come down or snap back up, I'd be looking to see how price consolidates and eventually potentially breaks out for continuation of that stuff. Now, if I go back over here and I go to a chart like, what did I trade? I traded Disney back in the day for an earnings move. Where was that? Was it Disney? I can't remember. Oh yeah, it was right here actually, I think. No. Oh yeah, no, it was here. I'd have to go back into the Discord to see exactly when it was. I don't know if it was here or not. I can't. I know where Target was. I did Target too. Let me see if I can find it. I can't remember the exact date, but it was around earnings. I'm trying to look up just an example. Just to show you very clearly what it is that I look for. I know I did Disney. I just can't remember when. Not that last earnings. Oh, there it is, right there. Okay, so here we go. There it is. Okay, so this earnings right here on February 20, I don't know, when was this date? 2024, right? Yes. February 2024. On this earnings, we saw a nice big bullish move. Okay, and then I wait for the consolidation. So price went up, I'm not going to chase it, and then price pulled back down. And look at volume. Volume came in a little bit, and then all of a sudden we get a day where we go from a pretty bearish day, and then the bulls step in, create this little hammer candle, right? A hammer candle, like if you're just analyzing a candlestick, it just shows emotion, right? That's how you read technical analysis. It's just emotion. So as price pulled back in, emotion is what? It tells us that it was very bearish, but the bulls really did step in. So when I look at this, I'm like, okay, I'll execute when we start breaking above the high, and I'm going to have a clear idea for a stop. And then I'm going to trade it for back up to here. So very simply, you look at the risk and the potential reward. And then you could leave some runners on however you want to trade it. But that was one that I traded. That is an example of something that I would look at after earnings. Okay. Okay, so there's Disney. Carvana. Palantir. Palantir seemed a little long in the tooth, but there's been many times where it showed nice consolidations. It does get wacky and wild on, like, look at this earnings move. Boom, boom, like, right? So a little bit wacky and wild if you can manage through this stuff. But in this current moment, earnings are around, like, what is it? Our earnings are today. So I don't even, okay, so here, this is what I do when earnings are today. I'm going to show you right now, okay? Trade tab. Go into this. It's looking at 157% implied volatility. We're currently trading at 41.75. The expected move is $5.58. So I immediately do this. From where we currently are, now it matters more when we close, but you go up. This is going to be a big one. $5 and what did I say? 68 cents? 58 cents. It don't matter. That's 10 cents. That's kind of matters. Okay. We're giving a rough estimate there. I don't really need to be exact because the market's going to move into closing anyway. I'm going to duplicate this. I'm going to go back over here, go like that, and then I'm just going to draw a line like so, okay? Boop-a-doop-a-doo. So, and you can do this on your screens too, but where price action currently is, I'm going to duplicate this out. Okay. And I'm going to remove the vol bands because I don't need these on my screen right now. So if I go to the daily time frame now, this is what the market's pricing in as far as risk going into earnings. And there are high probabilities that we tag these levels. So by the close of today, we're probably tagging one of these levels. This is what the market's saying now. I don't initiate new positions into earnings. I just don't do it. Sometimes I even exit a lot of the position going into earnings because they're a binary event. Like fundamental analysis is like, I can't compete with financial analysts. They have better data, better everything, and even they get it wrong. So I look at what the market price is and is risk, and you could maybe do like risk butterflies if you trade options or something like that. But I just don't bother. I just don't get into it. There's been times where I accidentally leave a position on, or if I'm like, I am like kind of bullish here. So what would I do? If I wanted to execute into it, I'd be like, okay, it's pricing in about a $5.60 move. So how many shares would I feel comfortable? How much money would I be willing to lose if I'm wrong? And the price action is 5.6 per share. So for example, if you buy 100 shares of Palantir and it does move 5.6, right? It's $566 that you'd be potentially risking, right? We can have 2 standard deviation moves, so it could be more, right? But if I'm okay with like losing $500, maybe I would buy like 80 shares, right? If I was okay with, but I thought it might be cool to win like $500 and try to, coin flip it, I'd be looking at that, right? That'd be one way to approach it. The other way to approach it would be doing something like an option strategy, which would make more sense to a professional risk manager, right? Because we don't know. You can have something like Capri happen, which I doubt this is going to be the case. But look at Capri. This is why positioning matters, right? I don't think that this was earnings or anything, but it was down 50% in a day because of news. Like, you don't want to take an oversized position and then wake up to your portfolio being down 50%. So, for example, if you have a 100K portfolio and you took a 6% position in CPRI, okay, if it drops 50%, that sucks, but B-U-T-T, it sucks. But in the grand scheme of things, you lose 50% on that trade, but you only risk 6% of your capital of the 100K. So in theory, your portfolio in that single day loses minus 3%, which is a pretty big hit. But like comparatively, like as far as beta goes to a portfolio, especially on one position, but you can make back 3%, right? If you want to make back 3%, you typically just need to make 3%. But if you lose 50% of your portfolio, you then need to make 100% of your portfolio, like 100% of gains, in order to make that 50% back. Because losses, they work geometrically against you. So hopefully that helps. Let's go over a couple more names. Starbucks. I liked Starbucks. Let's see where it's at. I liked it over here. This is consolidation. Looks like it's holding up. Earnings got out of the way, so that's nice. Yeah, I like Starbucks. It's starting to recoup some of these levels, and you can see that it is getting pretty tight here. So, I mean, I'd be open to trade this, right? You see lows, you see higher lows building up. It's right at around that $100 marker. You're above a rising 50-day. The 200-day is flat, so not really a trend there. And you have a clear idea of where risk could potentially be on breakout. So if you're trying to play a continuation, right, and you want to speculate, maybe you enter a little bit. But if you get down here, get out, and then wait for it to set back up. And if it goes right here and you enter a little bit, but then it starts breaking out, you can always add more. And if it goes woohoo, congratulations. If it goes like woohoo and woohoo, well, you can move your stop to break even or just get stopped out on that risk. But this is what I like to see. So yeah, great call out on Starbucks, right? Great call out because it looks good. Why does it look good? Not because I know where price is going to go, but because I can visually see price action is contracting, and this is what I like to see. If price action and trend confirms something for me, I like to back my risk into something like this. And very simply put, if I'm wrong, I know when I'm wrong. If I'm right, I can make multiples of my money. Good call out. I'm going to just check one more time just to see if Mike himself from ICT is going to come into my chat. Ladies and gentlemen, you won't believe what I see here. Absolutely nothing. You probably did expect that. Hey, JPM, I'm an ICT trader. You guys hiring? Matt, shit. How long have I been trading? I mean, I'm 37 now, and I've been investing and being part of the markets for over 20 years now, right? I mean, that's how long money's been in that investing stuff, but actively trading. So maybe I would say probably like actually doing this, like legitimately, like trading and swing trading, probably like 6 to 10 years. But there's more time on top of that too, of like learning the markets and, you know, random stuff. And I'm always constantly learning. But, you know, like when people say I've been involved in the market for 20 years, it's like, okay. But now, like, data is readily available. Like, you can absorb the data that I took for the first 5 years, 10 years, and absorb that data in a single book, right? Or a single video nowadays. Like, so it's changed a little bit. And then, you know, when I, 20 years ago, when I'm 17 years old or 18 years old, going into that stuff, it's like you don't have the capital, typically, to be to really take it to the next level, right? And there was a lot of different. The market was a lot different then. So, really, I would say like 10 years. Yeah, doing this actually, like honing in the skill. And then even prior to that, it's like you still learn and adapt and adjust as you get more data and more tools. And in recent, like I would say just in the recent last 3, 4, 5 years is when things really started to click. All right. All right. Like 2 years ago, I believe it was 2 years ago, I stopped trading options altogether. 1 year ago, I really stopped shorting the market pretty much altogether. Because I looked at my past trades and I was like, what happens if I remove this, and what does my P&L curve look like after this point? And I'm starting to realize, and looking back through my data, I'm like, I don't need to trade options. I see some big wins. I see some losses. Then I look at shorting, I'm like, how did I feel trading this short? Did it feel good? And I was like, not really. And then I say, okay, well, how much did I make on this short? I mean, was it really worth that? So I'm like, okay, maybe if I'm shorting, it's going to be few and far between, right? So I'm going to cut my shorting off. So really, when it comes down to really being a successful trader, it's once you have so much data and you'll learn so much things, it's about what you remove, right? Removing a lot of these aspects from your trading will actually help you move forward. And I can prove this because many traders, they'll take, let's see, each one of these is a trade. Each one of these is a trade, okay? Now, this one is a winning trade, a winning trade, a winning trade. We'll call this a winning trade. We'll call this a big winning trade. Small winner, okay? And then this one is a loser. So anybody that you can sit here and you can look at your data and be like, dude, I have a huge win rate. But if I would have just solved for this one loss, my portfolio would look so much better. And that is the problem that most people have, is they can go back through their history and say, dude, if I just didn't do those 3 trades, my portfolio would be significantly better, right? Maybe you're flat for the year, but you had a lot of winning trades. But then 3 trades, if you wipe them out, you're up 10, 20% for the year. So I kind of went back through all of that stuff and I said, I don't really have like my edge would really be developed here if I just actually don't even bother trading options, and if I just don't even bother shorting. And then I added another level of complexity in saying, when does my portfolio operate best in? I'm like, well, it's these market conditions. And then now this year it's really showing. And now I'm just going to keep kind of getting verified and showing you that I back off when my conditions change. I add on when my conditions are better. I risk a very specific amount, and I go from there, and that's it. And that's what it takes time to develop that stuff. But you gotta want to succeed, and you're gonna have to be patient. If If you're not patient, you're gonna make mistakes, and it's okay to make mistakes. But what kind of mistakes are you making, right? Is it a losing trade based off of your strategy, or did you completely and obliterately just like deny what your trading strategy was, and you just went off script? Another thing that I kind of stopped doing more of is active day trading. I like day trading on occasion. That's no surprise there. But I know what conditions the market need to be for me to actively day trade. But I'm not going to be actively executing. So I stopped doing a lot of very, very, very faster amount of intraday trades. I look to hold positions longer through swing trading. So I just focus on what works for me. What works for me doesn't work for everybody. So, and that's okay. Just pick something that works for you. Know yourself, know your risk appetite, and go from there. Oh, thanks, Glenn. I just saw that tweet. I appreciate it. PAX. Oh, hey, yeah. Blue. Let's see PAX. I'm gonna have to hop off here soon, guys. I'm a little tired. I don't think he's gonna show up. I think we all know that. Oh wait. Oh no. Whoa. PAX exploded. What happened here? Was there news out? Circuit breakers, obviously, because that's some big volatility. Oh, Hindenburg Research came out with a report. Okay, so here we go. So PAX, let's ignore this trading day, because this is a trade that I would definitely have taken. Actually, I think this was on my list to take. All right. Look you got these series of higher lows. Risk tightens up very clearly here. Offers a great risk to reward. So if you took it, it's a great opportunity. Then news happens. So where would you have gotten stopped out? You would have gotten stopped out right over here. And you would have ignored all of this data. Blah, 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 blah. Right? Sometimes you get a big gap down. So this is why position sizing matters. That's a big move. I haven't looked into to what the report is. But yeah, I wouldn't be touching this one anymore. I'll just let it go, let it set back up, and go from there. But the chart was looking good, multiple bases. I think I looked at it over here, obviously here, and then even here. And then also, I know for a fact I traded it over here because I'd have to go back into my original posts where I talked about this setup. How's the original setup here? And then the second base here. And there you go. Boom. In one fell swoop, we undercut all of that. So that's why risk management is important. Good thing for calling that out, man. Thanks for showing me that. That's crazy. Not doing anything is just as speculative as doing a thing. Not doing anything is... I guess, maybe, yeah, maybe. Yeah, I can see that, Roger. Roger's saying basically not doing a thing is just as speculative as doing a thing. In other words, like sometimes not taking risk is a risk itself. Is that kind of what you mean? Right? I don't like to invest because of risk. Okay, well, then you operate at the risk of not compounding money, right? There's a risk involved in that. Like there's risk on both sides. So I think that's what you mean. But yeah, I can see that as the case. All right, we'll look at TLT. I'm gonna call it quits here. I'm exhausted waiting. I swear to you, if I get off this live stream and he hits me up all of a sudden, I need all of you to be like on Twitter, be like, dude, that's some BS. Because that would be so BS. That would be BS. But if he says, let's do it on this day or whatever, and we can have a live stream, once again, if he's watching this now, like, dude, it's not going to be a big deal. I'm not going to try to prove your concepts incorrect, right? I'm going to just show you market data once again. And then you can say, well, it's a concept because I don't need to look at that. And like, okay, yeah, cool. And then we talk about it. There will be no name calling of him. If he wants to go on live, that is. And I'm going to have comments open, obviously. TLT, I'm just careful with rates altogether right now because of this whole presidential election stuff. And then obviously we have the Fed right around the corner. And I don't know what the market's trying to, I don't have a narrative as to what the market's trying to do here and what it's like, because the market is a discounting mechanism. So I don't know what the market sees right now at all. All I know is what gold has been doing. It's been hitting these new highs, right? Rates, they've been freaking flying. Like, so I did take a position in TLT. I use TMF. If you want me to screenshot it, I'll screenshot it, but I feel like I've earned the right to just tell you that I did, and I'm already out of the position. I took it on Friday as just kind of like an overextended trade. And then also what happened with oil that specific day, right? Oil, so for example, I'm not going to get that chart back up. I do want to get off. So if I looked at USO, right? USO was down big on the day, okay? So the prior trading day, 11-1, sorry, it was down. What was the 10-year yield doing? It was up and it closed at the high. So I saw this divergence after a strong move, and oil can typically be a leading indicator. It's proven that. It's shown that it has done it. In fact, when the 10-year yield started dropping here, oil fell ahead of time. When the 10-year yield started rising here, oil did it ahead of time, okay? Because commodities can lead this. So I went long and I used TMF, small position, obviously, because it's a margin product or a leverage product. So I just adjust for that differential. And I got out of it this morning, right? Because I don't know what rates are going to do, but sometimes these divergences lead to a quicker trade, right? So yeah, I'm just hesitant to get too involved in these rate markets because I don't know what the outcome's going to ultimately be. So maybe just email it to me, Glenn. Maybe I can look at it that way if you just email me from YouTube. But I'm going to be hopping off. I don't know, how do you send the chart? I know in TradingView you can like make a link and then send the link. I don't know. Somebody's done it before, right? They sent me it and I just pulled it up. I don't really know how they did it though. Thanks, Blue. It was a small trade. It was nothing crazy. It was just a quick little hit. All right, everybody. We tried to get him on. He didn't show. It doesn't really matter, but it is what it is. I showed up. It's important to show up. Okay. Glenn, actually just post it on Twitter. That's one way. Post it on Twitter and just tag me. I'll be live again too, and we can pull it up another day if you'd like to as well. But I'm going to be hopping off, everybody. I'm tired. I'm exhausted. I need some air. I'm going to go give my boy a hug. I appreciate you being here, chatting with me. Hopefully today's session helped out. Got some good key levels, expected moves, and so forth. Just be well aware of how big this implied move is for the week, right? This is a huge implied move of risk. $15 in the SPY. Get ready for some rocking and rolling, okay? Just protect the risk and go from there. See you guys later. I appreciate it. Thanks, Roger. Thanks, Tree. Thanks, Derek. Thanks, John. Thanks, Glenn. Thanks, Minute. Thanks, Sid. Thanks, Blue. Thanks, Matt, for showing up. Travis, everybody out here on YouTube, and then everybody out there on Twitch. We got Z, Cool Burns, CJ Beats, LA to Mex. What's up? Straight out of the music was straight out of the 80s. Thanks, Tony. Thanks, Exotic. Thanks for being here, everybody.